Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, happy Friday to you, Jim.
Bob, lots of questions from our listeners today, so let's wade right into it. We have Justin with a question. One, he says, it looks like the monetary base is going straight up. Would this imply we are expanding into hyperinflation? But he also has some charts that he looked at that indicated that we're going into deflation, and that the transactional turnover of those dollars is going down. So, of course, his question is, inflation or deflation?
Yeah, that's it. And good coverage on the charts, Justin. Yeah, monetary base is soaring. All the frustrated inflationists are back into the 1970s, and they think it's going to fly. But as your charts point out, the velocity of money, or the rate of turnover, is thwarting the huge expansion, and this has happened on previous contractions. But what I like to point out is that in a great bubble, the private sector is capable of creating all the credit and even more that's necessary for speculation. So you don't need the central bank to provide credit in a bubble. And then, when the bubble's over, the contraction is such that velocity of money, which goes up during a boom and then down during the bust, makes the Fed attempt impossible. It just renders them hopeless. And this shows that all through the 1929 and early 30s crash, the Fed was buying bonds out of the market, and it didn't make any difference. So, good question, good charts, and I think it'll work this time. The velocity of money will get the insane practice of the Fed inflating all the time. So, good question.
From James, hello, Jim and Bob. I've been an avid fan of Bob's weekly interviews on Howe Street for years. I recently became a happy subscriber to Charts and Markets because their work and analysis makes the most sense to me, and I truly appreciate the timely updates in my inbox. Bob often talks about the deflationary effects of a post-bubble contraction and how the real price of gold will rise, creating healthy profits for producers. He also mentioned how much fun it will be to invest in select junior explorers as we enter a long 20-year bull market in precious metals. Yet, other well-respected analysts I follow on social media speak about 40-year cycles and how this most recent rise in the gold price has reached its peak as of 2021 as this gold bull cycle comes to a close. What's up with that, Bob?
Yeah. Well, I'm just going to recite what we've been doing, and my old research is that the real price of gold goes down in the final phase of a financial bubble, and the gold's real price, gold stocks and gold's nominal price all really soared up to last July, a year ago, and became very overbought, which we advised taking some money off the table. So then now it's been hit fairly hard and is, let's say, the real price of gold is stabilizing. So that it's done what it should do in the last thrust of a financial mania. And, going the other way, copper's real price has increased in the final phase of a great bubble. And copper's real price has really gone up, and it's getting very overbought. So this is correct if this is the final phase of a bubble, and I think it is. So we should see then soon copper can have a secondary high in the year in July, which is working on, and then come after August it heads south, and so I think most commodity prices are going to go down. Then that will then put gold's real price up, which increases the profitability of gold mining. But the problem is that if the big stock market goes down, it'll take the gold stocks with it. And yeah, I do like it's a long term. The post-bubble contractions have been many years with the business cycle coming and going, and but with the gold stocks outperforming the S&P on the rally. So, I think it's working out, and thanks very much for the question.
Something when you're looking at copper with the push for electric vehicles, the average electric car uses 300 pounds of copper or 136 kilos. That's certainly something you have to keep an eye on, isn't it, Bob?
Oh, yeah, but I remember I got my start in the business with Placer, the big mining company out of Vancouver, and they were doing both gold and base metals, particularly copper and molybdenum, and their research guys were pretty good. And one of them said to me, Bob, no matter what decade you're in and where we go in the future, there will always be a new use for copper, and I think he's right. But you still have market forces going on here, and copper's been behaving recently according to schedule, and I think it'll fail after August. So, yeah.
We have a question from Jeff in Ohio. Hello, Jim and Bob. Since we're living in the greatest financial bubble in history, should this be followed by the greatest contraction in history? And would Bob be able to discuss the social, economic, and political consequences of this contraction? Thank you, Jeff in Ohio.
Yeah, Jeff. Hey, that's a good one. Yeah, I think the contraction is inevitable and will be visible come October. And yes, the degree of the sell-off or the bear market is proportional to the craziness on the way up. So, and then also if you're at a lesser exchange, like in New York in 1929 was a lesser exchange, and the S&P fell something like 80+%, where the senior financial market, London, their equivalent stock index only sold off 50%. So it also depends where you are. Perhaps New York Stock Exchange this time might sell off by about 50%, but exchanges in other countries could even be more, maybe 80% or so. Now, what was the other part? Oh, social, economic, and political consequences. The financial mania and particularly the Fed has been corrupted recently to providing unlimited funding for yet another experiment in unlimited government. And the current administration in U.S. is particularly brutal. And I think that in the past, you've had wild financial markets on the way up, and it seems that authoritarian politics and bureaucrats get very ambitious with that. And then when the financial side deflates, my guess is that the hyperactivity by the left will also deflate. Yeah, as a matter of fact, started writing a book on it. So, good question for me, Jeff. Thanks a lot.
Question from Kathleen, and you know there's going to be a musical reference in her question, and let's open it up, and yeah, there is. Hi, Jim. Hi, Bob. How can you best explain Fed Chairman Powell's very odd monetary policy of blowing the biggest financial bubble in all things since the South Sea bubble? He reminds me of David Bowie's Space Oddity song, Ground Control to Major Tom, your circuit's dead, there's something wrong. Can you hear me, Major Tom? By the way, Canadian astronaut Chris Hadfield sang that song from outer space. I love astronaut Hadfield. He was also the U.S. Navy top test pilot of the year one year. Anyway, is Chairman Powell seeing or hearing something other than the rest of us from his other monetary planet?
Yeah. On the last part of the question, Kathleen, you have what some people have called the public man. So this is the chairman of the Fed speaking, and he has to say what the chairman of the Fed should be saying. Maybe, who knows what's private, but I think these guys really believe that they can keep the boom going, and that when the Fed was first formed in 1913, major people at the time really understood that if you had a financial crisis, it would be followed by a recession. So the tout behind the Fed has been that as a gifted lender of last resort, it would prevent the crisis, and there would be no more recessions. This is a very appealing idea, but since the Fed was formed, there's been 18 cyclical recessions. The theory doesn't work, and yes, I would say that each for the participants, Kathleen, each of the participants in the current financial mania, this one, 1929, 1873, and all the 1825 was a huge one. It's always been the biggest one in history. It's just that they get bigger each time because, the economy's got bigger, the market cap gets bigger, and you've got more and more participants. So, but it is the biggest in history, but each of them for the participants has been the biggest in history, and they all have failed, and they've all suffered heavy liquidation in the fall, typically as they occurred in London when it was the financial center. They peaked in March or June, dithered around through the summer, and then got hit very hard in the fall, and completed the liquidity problem maybe very heavy into late October, and then by the middle of November, kind of testing, and the problems were cleared, except one, and that was the big one of 1825, when the liquidity crisis went right on through December and right into January. It was a real horror show. So it's going to be fascinating to follow.
Another question for us comes from Michael. Hello, Jim and Bob. More financial experts are turning bullish on China and emerging markets. They say that stocks like Baidu and Alibaba are a steal at these prices and not to overreact to the Chinese government's temporary crackdown on certain companies. Bob, should we test the waters and begin acquiring China and emerging markets, or should we wait for a correction in the U.S. markets?
Yeah, Michael. No, Jim and I were just talking a little while ago that the apparent crackdown by Chinese authorities may be the market failing naturally, and then the authorities wishing to look like they're in control. And this is, and it's an old game, you know, in a long bull market, the successful strategy has been buying the dips. We had one in the middle of June on our springboard buy. But then ahead of time, you can't really tell which is going to be the last springboard buy or in the last buy the dip, so you don't know. But no, the pattern has been that in the year of a great mania going on, that problems in outlying countries, and in March it was Argentina, South Africa, and Turkey, and that popped the U.S. dollar up to over 93. And then this continues through the year, and I think that what's coming out of China is that it is the next country to get hit by the sudden loss of liquidity, and the old schedule has been that ends up in the world's financial center in the fall, and that means New York and London. So, good points. I think we had good stuff flying until mid-year. Stuff got overbought, and I guess the important change now is that the credit spreads are reversing to widening. The U.S. dollar index is still building a base. One of our warning things is the gold-silver ratio, and it's beginning to warn of a possible credit crisis. So things look on track for a turn to adversity after August. Thanks for the question.
And Bob, so let's examine this Chinese crackdown on certain companies. They went after educational companies. Now they're targeting ride-sharing services. Why do you think they're doing this? Are they trying to find scapegoats for a declining market?
I think they're trying to look like they're in charge, because I saw one the other day where Hong Kong had sold off 4.5%, and then there was some education company that within that one day sold off 47%. So it looks like there's coming under pressure, and maybe it's the old game of the Chinese authorities trying to look in charge. Like somewhere here in the U.S., the low-grade junk bonds are going to rise in yield. And already the Fed is talking about perhaps it should raise rates to attack inflation and stuff like that. But in a contraction, you're going to get lower grade rates going up anyways. So, but again, there's always tempting for the Fed to look like they're in charge. So I think this time the disaster, folks are going to look at the trillions of dollars that have gone into the Fed's action to stimulate the economy in a boom, and they're going to look at it and become, condemn the Fed for wasting taxpayers' money on doing bubble things in a bubble. And then also you can have a growing number of economists with their critical facilities pointing out the same thing. These guys were providing all kinds of gasoline for a fire. So it's going to be interesting.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a headline that caught your attention. The U.S. housing boom is over. New home sales fall to the level they had last year at the height of the pandemic.
Yeah. This is sales have rolled over. Also, the price of new houses had a little setback, and it certainly reminded me of 2006. So I looked up our report that we did in late August of 2006, which essentially covered that housing mania, which was really crazy, would likely weaken. And I had an excellent article by Jim Grant at Grant's Interest Rate Advisory. He'd done a history some years before on, I think it was the Excelsior Life company building in Manhattan, and it was built just in time of the bubble completed. And then in that long bear market for real estate, Jim covered that not only did the equity holders go broke on it a few times, different ones, but also mortgage holders went broke on it as well. So it was just an excellent article on how bad the bear market for real estate can be after a great financial bubble.
The IMF is warning inflation could prove to be persistent, even though the U.S. Fed insists it's just transitory.
Yeah, all the old inflationists are on the bandwagon. I think the Fed has been reckless all the way along, and but with a socialist, the Marxist government in Washington, they figure that they can be even more evil. But I'm going to stay with the way history works, and that is you have a global peak in commodities, which was the last high was 2011. And then about a decade later, you have a wild speculation in financial assets. And this speculation in financial assets has been terrific, absolutely out of this world. But you also, with the final stage of a business expansion, you do get industrial commodities going up, which is the case, but it looks like they're in the process of peaking. So I'm staying with the case that after every great financial bubble in history, the prices of most asset classes have gone down in the subsequent credit contraction. So, and then you also, not just inflationists being excited, but you've also got what we used to call the permabulls in commodities. They're on to, what do they call it? The super cycle for commodities. They've been calling for that for the last 10 years, when actually the high in 2011 was in retrospect a very important one. So I think all the noise about the old 1970s type of inflation coming back is just that noise. Proper and full research points out that after all 5 previous classic financial bubbles, a fairly lengthy credit contraction followed, and I'm staying with it.
Bob, thank you so much for chatting with us.
Hey, Jim, it's always good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.